Hi. Let's learn about the housing expense ratio. A housing expense ratio is a comparison of housing expenses to pre-tax income. Lenders use it to evaluate borrowers for loans, often in the context of mortgage loans. This ratio may also be referred to as a front-end ratio. The housing expense ratio is a key factor in evaluating a borrower's credit profile for a loan, particularly in the context of mortgage loans. It is used in conjunction with debt-to-income when determining the maximum credit level to extend to a borrower. This ratio is essential in the underwriting process and can impact a borrower's credit approval, regardless of their credit score. The housing expense ratio, also known as the front-end ratio, is a partial component of a borrower's total debt-to-income and is typically considered first in the underwriting process for a mortgage loan. It involves disclosing a borrower's pre-tax income and summing all housing expenses, including potential mortgage payments, property taxes, insurance, and association fees. The housing expense ratio threshold for mortgage loan approvals is typically 28%. Debt-to-income is another critical component of loan approval, calculated by dividing the total monthly payments to creditors by a borrower's monthly income. Borrowers generally must have a debt-to-income ratio of 36% or less for loan approval. When considering a mortgage loan, underwriters will analyze potential stress that a mortgage payment will add to a borrower's credit profile. A housing expense ratio higher than 28% may be acceptable to lenders based on compensating factors such as low loan-to-value ratio or an excellent credit history. Additionally, applying jointly with a co-borrower can lower a housing expense ratio, as can choosing certain mortgage products with initial low payments. Borrowers may want to use the 28% and 36% levels when planning their monthly budgets, as it can help estimate how much they can afford in monthly mortgage payments. Here are 4 key takeaways. 1. The housing expense ratio is used to evaluate a borrower's credit profile for a mortgage loan. 2. This ratio analyzes a borrower's ability to repay a mortgage debt on a home. 3. Income ratios can keep borrowers with excellent credit from receiving approval for a mortgage. 4. However, having a co-borrower, like a spouse, can lower a housing expense ratio. Hope this would help. Thanks for watching.